Good afternoon, everyone. Welcome to our September webinar on participation lending. This is going to be a very, very interesting webinar. We have excellent guests, and we have a wonderful host in Vanessa Lowe. My name is Catherine Baxter. I'm going to be your moderator for today's webcast. And before we move into the webcast, I'm going to give us a few housekeeping announcements. We've had quite a few people already ask about downloading the slides. If you'll look at your console, there is a green icon at the bottom. It looks like a folder. So if you click on that, you can download the slides. It's a PDF document, however. And of course, this is going to be one of our webcasts where you can get a certificate of training, well, actually a certificate of attending for watching at least 45 minutes of the webcast, answering 3 of 4 poll questions, and correctly answering 12 of 15 quiz questions. I'm going to tell you about the icons a little bit at the bottom of your screen in 1 second. But notice our administrative announcements. Some people are having problems hearing this particular webcast, so please adjust the volume on your computer so that you can hear this webcast clearly. You may also resize the slide by dragging the bottom right corner. From this site, you'll also need to allow pop-ups. And at any time during this webcast, if you want to ask our speakers a question, you can do so. There's an Ask a Question feature on the left corner of your console. In fact, what we'd ask you to do, once we start the webcast and you know the speaker that's speaking, please ask your question and address it to that speaker. Okay, so we have, for example, Mike Dorsett and Ian Lample and Vanessa Lowe. So once you know one of them that is speaking, please address your question directly to them. And also, before we get to the Q&A portion of this particular webcast, we're going to push out a survey to you. So where you don't need to watch your email, just watch your screen because it's going to come right out once we're done with all of our presenters. And as always, in approximately 3 weeks, we are going to close caption this webcast for on-demand viewing. I mentioned that I would go over the icons at the bottom of your screen. You'll see 2 magenta-colored icons towards the bottom right. One is the test, the one that's the farthest right. The other one, it will show you your progress. So it'll show you if you've been listening for 45 minutes. It'll show you if you've answered 3 of the 4 poll questions. And, of course, the coup d'etat. It will tell you if you have answered the quiz correctly. And at that point, you will be able to print the certificate, which will be in the quiz magenta-colored icon at the bottom. Well, like I mentioned, I'm going to turn our console over in a minute to our host, Vanessa Lowe. And Vanessa is going to give you our NCUA disclaimer. Vanessa?
Hello, everyone. I'm so excited to be with you today to talk about loan participations with my guest speakers. Let's start with the NCUA disclaimer. As you know, we've been doing these webinars for more than 2 years now. Our webinars are offered for informational and educational purposes only. Remember that OSCUI's mission is to help support and to help small and low-income designated credit unions survive and thrive. We welcome all credit unions on our webinars, and we know we have many large ones. So just letting you know that we're trying to help and share information, but we're not trying to encourage you to do anything that wouldn't be in the best interest of your members. So continuing on with the disclaimer, NCUA does not endorse any particular credit union or vendor or their employees' products or services. All right? So hope that's clear to everyone. So what are we going to cover today? I'm going to start this time, and I'm going to do just a basic overview, the what, why, and how of participation lending, and then cover the NCUA guidance that's available. So far, we've got about 700 people who've logged in, but we have, I think, close to 1,200 people who've registered. So we know that we have a very large diversity of credit unions who are participating. We know many of you may already be involved in participation lending. We will say that particularly the beginning is geared toward those who may not know very much about the product or this particular type of offering. So it may seem basic to some, but again, hang in there with us, and I think particularly when our guest speakers start talking, you'll get something out of that. Then our guest speakers include Mike Dorsett, who's going to cover a couple of case studies just to sort of bring home the idea of what kind of problems could two sides of the participation lending partnership have, and then how do we solve that problem with this particular type of solution. And then we have Ian Lample. Ian's actually been on our webinars in the past. He was on the one about growing your loan portfolio, and so he gave us some background information on loan participations. We've brought him back to talk a little bit more because now he's created a partnership with a couple of corporate credit unions that he wants to talk about. And then finally, remember that the last half hour of each of our webinars is pure Q&A. So remember to submit your questions at any time. You can start submitting them now. You can submit them throughout, and we just love having those questions. And it's so wonderful to have our speakers stay on the line with us so they can cover your questions directly. All right, so let's go ahead and jump in with getting those faces to the voices. So that's me, Vanessa Lowe. I'm an Economic Development Specialist with NCUA's Office of Small Credit Union Initiatives. I've been with NCUA for close to 8 years now, and before that I was with the U.S. Treasury Community Development Financial Institutions Fund for about 7 years. Moving right along, let's hear from Mike.
Thanks, Vanessa, and thanks to all of you for taking some time out of your busy day to join us. I'm Mike Dorsett, President of Portfolio Performance, a consulting firm servicing the credit union space. I assist credit unions across the country in overcoming organic growth challenges with immediate, significant, and sustainable results. I also specialize in loan participations and locate and deliver a complete examiner-ready participation package for buying credit unions.
Thanks so much, Mike. And Ian?
Hi, everyone. Good afternoon. This is Ian Lample. I'm CEO of Loan Street. Loan Street is a technology platform to facilitate loan participation. Before starting Loan Street, I was Deputy Chief Counsel at TARP. I had been at the Treasury Department for nearly 4 years and helped roll out and then manage the majority of the programs the Treasury Department used to stem the financial crisis, including the Credit Union Program, the Community Development Capital Initiative.
Thanks so much. Okay, so I want to repeat here. I'm showing you a picture of the certificate that you'll get if you follow the directions that Catherine pointed out. Stay on the webinar the full time, answer the poll questions, and get at least 12 out of the 15 questions correct. All right? All right, I'm going to raise my voice a little bit because it sounds like maybe I'm not coming through so well. Thanks for that feedback. All right, let's start with our first poll question. We ask this every time we're trying to get a sense of the diversity of credit unions participating. Please click the appropriate answer. What is your credit union asset size? And we start from less than 1 million. Again, we're OSCUI. We know there's still a lot of small credit unions out there. And we go to as high as anybody over 250 million. We know there might even be some billion-dollar credit unions participating, and we are so glad that you've joined us. All right, let's give a couple of seconds for that to go through. While we're waiting for the responses to that, I want to remind folks that it's a good idea to print out the presentation. And Catherine talked about how you can do that through the green icon at the bottom. I want to say that the reason it's helpful is because as you're doing the quiz, you may want to flip back a little bit and look through the presentation that's printed out in your hand. Once we shut down the webinar at the end, we don't load it up again in the archives until about 3 weeks forward. So it's just helpful to have that information in case you want to talk to your colleagues about it tomorrow. So I encourage you to go ahead and print that out. Catherine, how are we doing with these responses to our first poll?
So we're ready to, I'm going to refresh it, and then we're going to push out the results. We notice what we have here, Vanessa.
Great. Thank you so much. All right. So our sweet spot is usually 50 million but less than 100 million. This time, it's actually greater than 250 million. That's 37.4%. I had a sense that those who are participating might be a lot of the larger ones. So glad you've joined us. And again, thanks so much. We'll keep moving on. Okay. So at the basic level, there's sort of 3 points I want to cover about loan participations. What is it? And again, we're talking to the smaller credit unions or maybe the larger credit unions who've, had great business but never seen an opportunity or a need to do loan participations. So at the basic level, loan participation is a single loan funded by multiple lenders. Multiple can be as small as 2. So the examples are you could have several credit unions fund one large loan, or you could just have 2 credit unions share a small or moderate-sized loan. The main tool that's used to outline all of the pieces of the agreement is something called the Master Loan Participation Agreement, and we'll talk more about that in detail once we go forward. But that's a key component of doing loan participations, is that you would have a master agreement that outlines all of the features. And then the final thing is, well, a loan participation needs somebody called the lead lender. So somebody, one of the credit unions, is being the originator of the loan. And so the lead lender's responsibilities include originating and servicing the loan. We'll talk a little bit more about that. Recruiting other credit unions to share risks and profits. Organizing, selling, and managing the participation. And the last thing is that the lead lender, and this is one of the benefits we'll talk about, deals directly with the borrower. So that lead lender, the originator, still maintains that relationship with the borrower. Let's continue on. So just a little background information, looked at some of our statistics, and this is from 2013, but loan participations have grown quite a bit over time, and I think they'll continue to grow because of what's going on in the industry. You know, some of the larger credit unions are kind of loaned out. They need, more money to lend. They've got a lot of demand, and they don't want to turn their members away. And then you've got some small credit unions that are kind of sitting on a lot of money. So I think it will continue to grow, and it's a great way for the industry to partner, which is one of the key components and tenets of credit unions. So back in 2013, the percentage of credit unions engaging in any aspect of participation lending was 23%, and the median asset size was $41 million. So that means that half the credit unions that were participating were smaller than $41 million in asset size, and half of them were larger. So that's an interesting thing to think about there. Then, so one of the questions I always used to ask was, so what kind of loans can be participated, or what is the participation loan field made up of? And so one of the big pieces is member business lending. Now, remember, for the member business lending, NCUA defines that as a loan of $50,000 or larger. Then indirect auto loans, or maybe even portfolio auto loans is used in participation lending. Residential real estate is a big one. And then private student loans, I think that's definitely a growing piece. Now there's others, but these are the top ones. We've got a poll later on to ask those of you who are doing participation lending what type you're actually using for your participation loans. So briefly here, let's talk about some of the benefits of participating from each side. So those that are selling participation loans, again, they get to originate rather than deny large loans from their members. You never want to have to turn a member away, but if you're loaned out at 99% or even more because you're using off-balance sheet resources, then you're kind of tight and you need some more resources. And so that's a great way then to go to another credit union and say, hey, it's my loan, but I'll sell you a portion of it. The premiums and servicing income. So premiums are essentially being able to sell the portfolio and charge a little bit extra. And then servicing income, of course, is the servicing income that you get from, even if you've sold off a portion, remember, they're retaining that relationship. So we get into that, which is, again, retaining and maintaining that member relationship. That's so important for any credit union. You don't want to give that up to other credit unions that you're doing the participation with, so that's what you keep. And then finally, it's just sharing the risk, right? Sharing the credit risk with other lenders. That's something that we'd always like to do. So those are the benefits for the selling credit unions. So what about the purchasing credit unions? And again, I'm speaking probably in large part to some of the smaller credit unions that haven't gotten into this. Well, you get to grow the number and size of your loans and your portfolio overall. As an economic development specialist, I do consulting with small credit unions, and very often the loan demand is low, and so they might have a loan-to-share ratio that is in the 20s or 30s, and so that's extremely low. And so trying to find a way to grow that loan portfolio, this might be an option. And as a related note then, if you grow the loan portfolio, you grow your interest income, which of course is key to moving toward profitability or increasing your profitability. And then finally, one of the things is you get to diversify your loan portfolio. Many small credit unions that are still single seg in particular you just have no diversity in your loan portfolio because you've got, they're all your members who work for that one employer. So diversifying it out to have both, geographic diversity, loan type diversity, those are really, really good benefits to start looking at and thinking about in terms of participation lending. So let's talk about, I just want to give you these resources. We're not going to go into too much detail, but we're going to go into a little bit about the NCUA resources that you should print out immediately if you're thinking about participation lending and start getting familiar with. So first is the regulation. So which regulation covers participation lending? Section 701.22, and it talks about participations from both the originating lender and those who are purchasing, and there's a short link to it there. The other thing that you should look into is the examiner's guide. So I always tell credit unions, the examiner's guide is like the Bible for NCUA examiners. It is their instruction on how to come in and examine a credit union. So it's a really good idea for a credit union to have and review the same information in preparation for their exam. But it's also really good information to review if you are considering another product or service. And so looking at the Appendix 10A, you'll find a section talking about participation loans, okay? And the examiner's guide and all of these resources are, of course, on the NCUA website. So before I go on, let me talk through due diligence and how important that is. And this is important for absolutely any product or service that you're going to do or offer to your membership or get involved in. Here, I want to break it down into three different sets of due diligence or sort of levels of due diligence that you might get involved in preparing to do loan participations. So first is, let's say if you're new to this completely, you might reach out to a vendor and say, you know what, I need help. I'm not sure about, how to find somebody who's selling them. So the vendor experts could include the credit union service organizations that are doing this, brokers, consultants, and IT solution providers. And we've got, a couple of those on this webinar, but again, we're not necessarily promoting them. We just invited them because we had communications with them. So first you want to do, and so again, like anybody, you want to do due diligence, and due diligence means essentially making sure that you're understanding what kind of a relationship you're getting into, what that vendor will do, what you're responsible for doing in order to make the relationship work with the vendor, and anything else such that at the end of the day, when for whatever reason you've partnered with that vendor, you've gotten something out of it that you want to get out of it. Too often I talk with credit unions that I'm consulting with, and they say, oh, well, I didn't know at the end. And so this, when we say, well, what made this, product or service not work well? When I talked to the vendor, they didn't tell me this or they didn't tell me that. And so it's thinking about what do you need to ask, what do you need to review in order to feel like, yes, we can partner on this particular project and end up with the thing that I'm trying to get. The next level after you have done the due diligence on the vendor expert who's going to help you, and again, let me stop here and say you may have staff in your credit union that such that they have experience enough in this area, they can be your person, your expert. But again, for smaller credit unions, you may need to go outside and find an expert to help you find that partner. So the next piece of due diligence is you want to look at who are you partnering with in the participation. So that's, for those who are buying participations, you're going to do due diligence on the seller, and those who are selling, you want to do at least a little bit of due diligence on the buyers. And so again, Mike will talk a little bit more about this later on, and sort of like thinking about how to do this kind of due diligence. But again, the same idea of asking enough questions and going through enough, sort of kicking the tires to make sure that you're finding the right partner. Then the third level in loan participation is essentially doing a review of what you're purchasing. So this is the buyer reviewing the loan portfolio, okay, or the individual loan if it's just the one. All right, so again, we'll cover more of this. Keep moving forward here. Okay, another piece of NCUA guidance to print out, very important. This is NCUA's letter to credit unions about due diligence over third-party service providers. So this provides really, really good information about what due diligence is and the different levels of reviewing and checking into a potential partner for any kind of a project. So it's generic. It's not specific to participation lending, but it includes really fantastic information, as you see from the bullet points down there. The next piece of resource that I want you to do, this is very particular to participation programs or participation lending, and it is NCUA's letter to credit unions that came out in 2008, letter to credit union CU26. This supervisory letter essentially reviewed several pieces of sort of guidance on how to evaluate loan participation programs. So very detailed and very specific to NCUA's experience at that point with loan participations. You know, some of it is a couple of sort of beware of, which of course we always want to raise to credit unions, and you know, as we learn, as we do examinations and see maybe some credit unions have not done participations very well, and those kind of things, it points out some of those things to be aware of and make sure that you don't have to follow in those same footsteps of credit unions that have not been successful in this particular area. One of the helpful things that I think was created back in 2008 to assist with this supervisory letter was we created an exam questionnaire. And so downloading that exam questionnaire, it's like a checklist, like, you know, we have a lot of different questionnaires for different areas, again, for the examination team to use, but it's fantastic for a credit union that's just entering the loan participation space to sort of see what are the key questions that I should be thinking about as I move into developing my loan participation program. So just, again, when it covers just some general requirements under the rules. So what's eligible for participation? So loans, so you're a credit union, you can make loans that were made to your credit union members or the participation partners members. And then loans that you're empowered to make means essentially if you are going to buy loans with a participation partner, you still have to have your own policies. So you need to know enough and have developed enough of your own infrastructure for doing that type of lending. So let's say that you're a credit union that has, you know, several products and services, but you haven't actually gotten into member business lending yet. So if you're going to go out and try to find a participation partner to purchase member business loans, you cannot make that agreement and start purchasing those loans until you have your own policies, your board has reviewed it, and you should have some staff then who has at least some level of experience and knowledge to monitor this new business that you're bringing into the credit union. Okay, so that's what we mean by loans that you're empowered to make. It's very important. That's a piece where I think a lot of credit unions have gotten in trouble. It's like they're completely depending on the participation partner and saying, well, they have the expertise, we don't need it, and that's not true in participation lending. How much can be participated? So generally the originating credit union must retain at least 10%. So you're not going to buy, let's say you're buying one, you're not going to buy the whole loan. You're going to buy, you know, up to 90% of it, or maybe even significantly smaller. So that's one of the pieces there. And then let's talk about the participation limits. So in terms of, there's a limit on purchases from a single originator, and that can be the greater of $5 million or 100% of net worth. And then purchases from a single borrower, so loans made to a single borrower, and actually it could be a group of borrowers too, that would be 15% of net worth for any single or group of borrowers. So it may be one loan to a group of borrowers, perhaps partnerships in a business or something like that. A little bit about the master agreement. Again, this is a master loan participation agreement. It essentially governs all the loan participation components. It needs to be approved by the board or a delegated committee or a member of senior management. This is something, again, a product or service you're getting into. You need to make sure that you have complete buy-in, that everybody understands what you're getting into and what's involved. How does it change the staffing responsibilities too, in particular? Very important is how does it change, either improves or maybe makes your portfolio more risky, but very often hopefully you're getting into it to probably improve the risk components of your portfolio and grow the portfolio. And then in the master agreement, all the loans that are participated are mentioned or referenced in there. So what's in the master agreement? So it provides a clear description of what the originating lender does, what the servicer, the servicer and the participant obligations. So these cover things like how does the servicing happen, what's the expectations on defaults and how do they get handled, foreclosure, collections, and other matters regarding the administration of the loan. That is just sort of a snapshot, but again, that agreement is critically important, and it's one of the first things you're going to start developing or find, or you're going to sort of review those participation agreements. For those of you who are looking to purchase agreements, your purchasers are already going to have probably sort of a blanket agreement, and so it's important for you to review that agreement, see if you accept the components that are in there, or if you need to make negotiations to change the agreement, because that's the agreement you're going to be signing with them. The other thing that's important for you to develop is your board policy, right? So what is it that you're now in agreement or approval by the board getting the credit union into? And so getting an understanding of the underwriting standards for participated loans, those limits that we talked about, limits on aggregate amount purchased, we covered a couple of those. How are you going to look at risk assessment and strategic planning? Now, you'll probably start with, again, doing that due diligence. So those are certainly components of that, but you'd want to mention that in your board policy. Measuring risk and monitoring it and controlling it, that's always important. Those are some of the main words that you're always using with anything, right? A board needs to identify, measure, monitor, and control risk in a credit union. And so bringing in participation loans, you need to identify what those risks are and measure, monitor, and control it. And then due diligence. How do you do the due diligence? Again, I talked about 3 levels of it, so you may want to mention all of those in your board policy. So again, these are just sort of the basic components of what you need to have available. This is another, so this is our next poll. What has kept, for those of you, so you can just not answer if you're already started participating, what's kept your credit union from participating to date in participation lending? So the first option is maybe you didn't know enough about it, and it could be because of regulations or something like that. You had trouble finding a seller. Maybe you actually tried to do it, but you weren't able to find a seller. There's some fear around required due diligence or monitoring for this type of service. Staff limitations, feeling like you didn't have a staff person who could really dedicate the time and resources to staying on top of that. And then one that we often hear from small credit unions is fear of partnering with other credit unions. So maybe you're afraid that the larger credit union that you're participating with is just in it to maybe come and gobble you up and merge with you. So, and again, we know, we talk honestly here, so we know that this is out there, so we just are trying to get a sense because it'll help us at NCUA sort of think about what's going on in the industry and how to overcome some of these challenges if we feel like they're challenges that we can overcome. So let's give it another moment. And again, let me remind you as we collect the answers on that you can submit questions at any time. We hope we're collecting quite a few of those questions. And at the last half hour, we will go through your questions. Catherine, how are we doing?
So we're doing good. I want to address, we're still getting some questions about downloading the slides. For those of you that may have logged in late, please use it's a green folder icon at the bottom of your console. Click on that. You'll see the PDF document. That's the version of this presentation that you'll use. So let's push out the latest results, Vanessa, and see what you have there.
Thank you. Okay, great. So I'm glad we're doing this webinar because 46% of you said you didn't know enough about it. Now, again, I'm not covering all the details because we only have an hour for our presentation part, but I've shown you the resources that you should print out and read through to know essentially the beginnings of what you need to know. So much of learning about any kind of new program or service is talking to other credit unions and then just starting to do it on a small scale so that you can test it out and see if it is appropriate for you. So that's the biggest reason is didn't know enough about it. Then we've got 33% who said staff limitations, completely understandable, particularly for smaller credit unions. Fear of required due diligence and monitoring. We're covering a lot of that here, so now you know. But that's the thing. If you feel like you're not ready for that, then if you don't have the resources for that, then it's probably not something you should get involved in. Finding a seller, that's interesting that some of you, it sounds like you've at least attempted to find a seller, so you might want to look at using some other resources to help with that. And then I'm glad to see it's only a 5.4% who said fear of partnering with other credit unions. So I'm glad that's not being too much of a barrier. All right, let's move on. And I'm going to now turn it over to Mike Dorsett. Mike.
Thank you, Vanessa. I'd like to take some of the fear out of this loan participation process over the next several minutes, and I'd also like to put some structure around the process for those of you, 46% of you who know just a little bit perhaps about it. Typically, the first step starts with policy development or refinement of your participation policy. Then we'll get that in front of the board and to make sure that there are no issues on that. And also, along those lines, you want to start talking about tolerance for risk. What is your appetite for risk, whether it's an MBL, a member business loan, or whether it's a consumer auto loan or an indirect auto loan. Seller due diligence, what are we going to do? These are questions you should be asking yourself. But what are we going to do in the way of investigating the partnering credit union, the originating credit union? And Vanessa spoke about it 2 or 3 different times in her slides, and that was due diligence. Those are the 2 most important words in the entire loan participation process, whether it's vendor due diligence, loan due diligence, or seller due diligence. Pool characteristics and loan economics is another thing that should be a top of mind when you start this journey to consider loan participations. What are we going to look for? What type of loans? What type of yields? And what type of credit quality? Loan examination. I recommend, whenever practical, to review 100% of the loans that you're purchasing. Now, sometimes, that becomes a little too great of a task, perhaps even given, staff limitations. But in any case, you need to determine what's available in the loan file to be reviewed, and then establish a limit in terms of how many of the loans you're buying do you want to review. Again, I'm going to say whenever possible, I would endeavor to review 100% of the loans. Your master participation agreement, you'll find that the originators typically have already completed a master participation agreement, and you'll want to get a copy of that and get it in front of your local counsel or perhaps your in-house counsel at the early stages of this process. And then monitoring. You're going to want to find out what reports are available from the originator and what other reports you would like to see from the originator and how frequently you can get those reports. Now, some of those will be reports through their core system. Others perhaps could be prepared manually. And then you'll rely on the NCUA website to get financial performance reports, call reports, and from the originating credit union in terms of audited financials periodically. So you think you want to tackle loan participations, but you don't know where to turn. My recommendations, talk with other credit unions in your network. Talk with QSOs, perhaps, that you are a part of or aware of. Broker vendors is a good solution. Consultants. And if you are looking for a participation, you can also get on the NCUA website, and you can create your own query on that. And I've given you some suggestions on what that query should include. It should include high loan-to-share ratios, low delinquency and low charge-off, strong capital ratios, and just a reminder that Vanessa had previously mentioned, eligible loan activity. Be sure you are empowered to offer the loans that you wish to purchase.
So, Mike, can you speak up a little bit, please? The audience is having a little bit of difficulty hearing you.
Absolutely. Due diligence on the seller. Some items that you need to consider looking at, the 5300 report, as I previously mentioned, audited financials, management assessment, especially senior management teams, sample reporting package, repossession policies and procedures, charge-off policy, and there's so much more. And many of these things should be referenced in the master participation agreement, along with roles and responsibilities of each. I want to share with you this seller case study. This was a $2 billion Midwest credit union that I contacted off of an NCUA report and found that their loan-to-share ratio was excessive. Again, a very successful credit union. Liquidity was a challenge, and loan-to-share ratio was extreme. I connected a buying credit union on the West Coast with this seller, and we did about 14 or 15 participations for the seller over a period of about 18 months. And I want to show you the results. Their loan-to-share ratio dropped from 113.73% to just under 104% in a year. And they continued to grow loans. The credit union is now $1.88 billion. So just a successful case study for the seller. And this is a favorite of mine, and that's a case study for the buyer. This credit union that I started working with in June of 2014 on participations was $110 million. Portfolio growth was stagnant, excess liquidity, and you can see ROAA was anywhere from 22 to 44, with loan-to-share ratio in the low to mid 40s. 18 months later, that same credit union, after about $15 million in auto loan participations and $20 million in MBLs, now has a loan portfolio in excess of $82 million. Their loan-to-share ratio has jumped 30 points to 71. And look at the ROAA. It's almost tripled. It's 114. So the benefits: portfolio growth, increased loan-to-share ratio, asset diversity with the new MBLs, as well as geographic diversity. And again, I can't mention due diligence enough. Be sure that you understand the structure of the deal, and we'll talk more about that in a minute. You'll get something called a data file from the originating credit union. Be sure and scrub that data as best you can, given what is presented to you, so it fits within your risk tolerance. Review as many actual loan files as you possibly can, and then assess what is available. And there are some pools where you buy all or you buy none, and then there are many out there where you can pick and choose what you want, given your specific risk tolerance limits. Here's a sample deal structure of about a little over a year ago. This was an indirect auto portfolio. We purchased 300 loans for about $3 million. And the weighted credit score on this was 732, debt-to-income ratio 31, loan-to-value was 96%, and a term of 72 months with an anticipated remaining life on this pool portfolio of 30 months. What was the price? The coupon rate, or the weighted rate of all of those 300 loans, was 3.49%. The seller charged 25 basis points for servicing. There was no premium on this, so the pass-through rate was 3.24% to the buying credit union. I want to speak a minute about the premium. It is a seller's market right now. You won't find, or rarely will you find, where you can buy a participation at par. I'm seeing them as low as 50 basis points and as high as 200 basis points, or 102% of the it would be the price of the pool. So again, pools today, you're not going to get par, anywhere from 50 to 200 basis points in terms of a premium. And in terms of the data analysis, I mean, once you look at your loans and you log your data, I mean, you want to look at again using the data file that you would receive, weighted averages on interest rate, term, credit score, loan to value, debt to income. I even look at the model year, the weighted average on the model year, and then calculate your concentration limits by underwriter. You don't want one underwriter underwriting a pool for you at the originating credit union of $3 million. So you want to make sure that you've had several underwriters and figure what that is. Concentration limit by dealership. You don't want $3 million limited exclusively to 2 or 3 dealerships, and then there become a problem. Make of auto. Why is that important? That's important because if gas price goes to $4 a gallon and you've got $3 million worth of SUVs that get 8 miles to the gallon, that could present a problem down the road. In the event there could be a repossession, that would certainly restrict perhaps the resale price. So you do want that concentration of the make of the auto and also whether it's new or used. You want that spread out. And words of caution on participation lending. It is not for dying credit unions. If you've got a membership that's no longer viable, then perhaps you need to explore other options. And if you've got an organic growth problem, you need to fix the organic growth problem. So you've got the loan participation strategy supplementing your organic growth. Loan participations, hard to stop once you start them. Don't rely on participations. Don't keep coming back to them. Fix the other underlying problems when it comes to organic growth. And please don't get complacent. And lastly, monitor the participations like you would your own originations. Thank you, Vanessa.
Thank you so much, Mike. Really great information, and thanks for those case studies. Again, sort of simple case studies just to sort of demonstrate to those who aren't doing this already what kind of impact it can have on your FPR numbers, your financial performance ratios. So really helpful. All right, let's keep it moving. I think we have a poll next. Here we go. So my credit union. So this is, I think, everybody on here. Yep, because there is a none of the above. So if you're not doing any kind of participation, you can click the none of the above. But the others, we want to know, does your credit union, do you sell loans to other credit unions directly? Do you buy loans from other credit unions directly? Do you buy and sell loans with other credit unions? Or do you buy loans from QSOs? And this is, I think you can only answer one of the questions. All right. Okay. They've pushed out. It's coming. It's on the way. As soon as it's up there, then you can click an option. All right. All right. We are going to give it a minute or a couple more seconds to get some more answers here. Remember, please keep submitting those questions. We have a good lot of questions, but keep them coming. If we don't cover all the questions on the live Q&A, what happens is we then we try to answer them afterward and then upload them with the archive. All right, Franz, I'm going to ask Franz to come around because I've lost my screen a minute. But
okay.
I can look at the results up here. So
we're going to push out the results now, okay?
Thanks so much, Catherine.
All righty. There we go. And there they are.
Okay, great. So none of the above. Okay, so half the people on the call have not done any participations yet. That's great. That's exactly who we're talking to. We've got 8% that sell loans to other credit unions directly. 18% buys loans from other credit unions directly. 13 buys and sells, okay, and then 13.8 buys loans from QSOs. Okay, great. That's very helpful to know. All right, let's keep it moving. I'm going to move it along. There we go. Okay. We are getting Ian Lample up on the screen. There we go. All right, Ian, it's all yours.
Great. Thank you, Vanessa, and thank you, Mike, for that great information. And so I'd like to take a moment today to talk about streamlining loan participation, because at the end of the day, if you don't have a cost-effective tool to enable you to do loan participation, you're not going to do it that often, and it'd be a shame because it's a pretty powerful tool to use. But before we kind of jump into some of the technology available to you, I think it's worth kind of highlighting some of the things we're seeing in the credit union industry. And I know Vanessa touched on some of these items before, but they're worth repeating again. And so as you see, we're in a tremendous period of loan growth. And so loan growth has started as early as 2011 and has continued strongly throughout this year. In fact, over the last 2 years, we've seen loan growth over 10% year over year. And in fact, some industry economists are suggesting that by the end of next year, at least a macro level, the credit union industry will pretty much have run out of deposits to fund loan growth. Now, on this next slide, which kind of shows loan growth on a more micro level, what is also very interesting is that much of this loan growth is happening at the largest credit unions, with much less so happening at smaller credit unions. Now, that does not mean that there isn't great lending going on at smaller credit unions who may be overlent and need to use loan participation on the sell side. That said, overall, the vast majority of this lending is occurring at larger institutions. And so it creates a dynamic where many smaller credit unions, even if they don't have a large amount of purchasing power individually, do have a lot of purchasing power in aggregate and can really support the larger originators who need more deposits to fund loans. Now, this dynamic is, not blind to the NCUA. Not only are we on this call with the NCUA, and we did a call last year on loan participation, but I believe it's now the former chief economist, John Wirth. I believe the NCUA came out with a new chief economist like yesterday. Had an article in the Credit Union Times last year, highlighting that, larger credit unions are having better luck riding this lending wave, that small credit unions can be impacted by economy of scale issues, and that loan participations are one way in which they can overcome these lack of economy of scale. And I think what John Wirth is referring to there would be that smaller credit unions oftentimes have fewer marketing dollars, fewer loan officers, fewer servicers and collection agents. And in my mind, those are not things that will disappear overnight. And so loan participations are a great way for smaller credit unions to really leverage the resources of larger institutions that may have access to more dollars to market and generate new loan originations. Now, the potential for loan participations is actually incredible. So if credit unions could efficiently and cost-effectively participate loans, they could maximize the entire industry's lending capacity, right? So when you look at those two slides you had before on the macro and then on the micro level, if we can help smaller credit unions purchase loans from larger credit unions, we can maximize the overall capacity of those large credit unions to lend. It truly will support small credit unions. As I'm sure many of you know, that loan assets have a greater rate of return than permissible investments. And while we don't have a chart on it here, I've seen a chart showing the difference can be as much as 400 basis points greater return on loan assets over permissible investments. And overall, if we're growing the amount of lending in the industry, supporting small credit unions, we can increase the overall market share of the entire industry. And I don't mean just against banks, but especially nowadays, there's a tremendous amount of non-depository lenders out there that are gaining market share. Now, the current market practice, which what really brought me to loan participations, is how intensely manual this process can be. As I'm sure we've already heard on the call today, people oftentimes individually negotiate every agreement with every single one of their partners. As you can imagine, that gets very expensive, hiring counsel for every deal, on both sides. It just raises the cost and becomes, honestly, cost prohibitive to sometimes work with many partners. Due diligence for the loan information that you're seeking to review can be scattered across multiple locations. You see, I'm sure you know, people send out emails and they send out faxes and they'll even send CDs in the mail. And I remind people, especially in this environment, that a fax is not an encrypted way of communicating with another institution. Email, unless they're using a specialized program, is, again, an unencrypted way of sending information. And CDs in the mail, unless they're encrypted with a way of, structuring the way for the receiving institution to decrypt that CD. Again, all of these are unencrypted ways of sending information around. Plus, if you're getting information across all these three forms, you now have to somehow aggregate and keep all this information to make sure you're properly doing your loan file due diligence and monitoring the loan and being able to show that you're doing this to the NCUA. Every month, people are oftentimes manually distributing payments. So again, you can imagine that it can limit how many people they want to work with. If every month they've got to figure out how many people and where they're sending all the money. There can be insecure and inefficient document storage. And so what I mean by that is, it may not just be when you first purchase the loan participation that you need to review the loan information. There may be updates, especially for business lending, that can occur from time to time. And if you don't have an efficient way of getting access to that information, if every single time you want to look at the loan file, you need to call the selling credit union, that can be incredibly inefficient for both parties. And then, of course, every month, you need reporting from the selling credit union to the buying credit union so that you can properly report and monitor on your own 5300 reports, your loan participations. As you can imagine, these reports can be vary tremendously between different institutions and can be inefficient for institutions to do, and oftentimes causes them to limit the number of partners they want to work with. And so when we looked out on this market practice, just in our mind, it seemed vastly too complicated and difficult to do, and it seemed to us that there was no reason for it to be that way. So here at Loan Street, we spent a lot of time developing a technology, and I'm sure there are other technology partners that you can find out there who have done similar things that we have, to really streamline this process. So in particular, we know when we are talking to other members of the credit union industry, the corporate credit unions were also looking for a solution. We know that this was on their strategic agenda for the year to kind of solve how do we make loan participation streamlined for their members and for the entire industry so that really any size credit union can engage in loan participations. And on the side, you see that we partnered already with Aloya, Corporate America, First Carolina, Louisiana Corporate, Volunteer Corporate, and Tricor. But in addition to the ones you see on the screen, we've also partnered with Corporate One, Kansas, Mid-Atlantic, and many others, with all of the corporate credit unions realizing that if we can bring to bear a more streamlined solution for the industry as a whole, we can really facilitate a much better outcome than any one institution trying to create a solution on their own. And so some of the things that we think about, and you should think about when working with any technology vendor, is how do they simplify and streamline, not just the regulatory compliance, but also the business case. So some of the things that we do is, when you're talking about that master participation agreement, we have one agreement that applies to every single purchase or sale that occurs through a corporate credit union with Loan Street. And that reminds me, you don't need to be a member of a corporate credit union to use Loan Street. It's available to any credit union, even though we have partnered with them to facilitate a broader marketplace. But once you sign, and join with your corporate and Loan Street, you never have to sign another participation agreement, so you're not out there negotiating a new deal every single time. It saves a tremendous amount of money so that you can work with either your preferred partner or many partners. We require clear risk retention rules, so the seller has to disclose how much of the loan they're selling and what they're keeping, and then our technology will enforce that amount. We provide uniform and secure tools for reporting, monitoring, distributing payments. And this is where the corporate credit unions are incredibly powerful. We can ensure that if you're a selling credit union, the proceeds go directly into your corporate account, and then when you're making monthly P&I payments, we can deduct it from your share account and put it into the share account at the buying institution through their corporate credit union, making the distribution extremely automated and efficient. And then we provide uniform reporting about, both on a portfolio level, all the information that goes into your purchase, plus the loan level information so that you can properly report, monitor your loans, and tie it to the monies you receive from the selling institution to dramatically reduce the cost of kind of monitoring and administering the loan of the life of the loan. We give you very simple tools to search for credit union loans. And then for sellers, we also protect your ability to control who can see your loans and how much information they can see so that you can ensure you don't give away any competitive information to another party that you don't want to. Now, how we create all this uniformity is we use a single kind of user interface for every loan file or pool. We structure information in a very clean way so that, you have different tabs for different types of information, with all the loans having the same kind of interface. So a details tab is going to have your summary of the material terms of the loan that you're reviewing. The access tab allows the seller to control who can see their loans and how much information they can see. The syndicate tab will track who the investors are in the loan for the seller and have a copy of the confirmation of purchase and sale. The data room is unique to every loan and is where you can, in a secure and encrypted way, put up the loan file, the application, the credit reports, the note, so you have 24/7 access to all the loan file associated with the loan. And the update, the payment tab, which is incredibly important for your reporting and monitoring, what we call the full waterfall, right? So you can see your principal, your interest, your servicing fees, any other taxes associated with a payment. And then this is where a selling credit union can choose to use their corporate account to distribute payments to the buy side. The messages and notice tabs give you all your notices that you need to monitor your loan and allow you to do due diligence in an encrypted way. And then, of course, we provide voting. So in the event that a loan does go sideways, you have the tools to do an automated workout. Now, for the buy side, we give you very simple tools to search for loans and loan types in different institutions. So you can search by credit score, geography, type of loan, whatever, whether it's auto or residential, what have you. You can buy directly from any institution through the platform, and then you get, you can manage all of your loans across all of your sellers using a uniform structure to make it efficient to work with any credit union, whether within your corporate or across corporates. And again, my name is Ian Lample. I'm CEO of Loan Street. Chris Wu, who's our COO, is also very knowledgeable about loan participations. We're happy to answer any questions you have about loan participations, our technology, or corporate credit unions in general. And with that, I will turn it back to Vanessa because I know she has some more polling and questions for everyone.
Thank you so much, Ian. Yes, let's move on to another poll. All right, this one is, what type of loans are you participating? So this is for all of those, I think, 50% who are already engaged in some sort of participation lending. And again, you're either, whether you're buying or selling, let us know. Is it auto loans, MBLs, which is member business loans, mortgages, student loans, consumer loans, or some other type? And with this question, you should be able to click all that apply. Okay, so you can click multiple responses here. I'm going to ask Catherine to tell me is it a question? We're having a little sideways conversation over here. All right, we'll cover it. Okay. Give us one moment, and we're going to show you the results here.
Let's refresh it again. And let's see, let's give people a few more seconds. We've got a lot of questions coming in. So I'm going to refresh again, okay? And let's push these results. And let's see, here they are. Come on. There we go.
All right, great. Thanks so much, Catherine. Here we go. The biggest one is MBLs. Okay. We had a feeling about that. That's 50%. The next is auto loans at about 39, 40%, mortgages at 24%, student loans, I said that was a growing piece, and we've got about 8% doing that, and then 10% consumer. Big question mark for me then, what are the other ones? I've heard that there's some credit card maybe participations, things like that. So thank you so much for those results. Let's keep moving forward. So we're going to move over to the Q&A. But I want to remind everybody about the certificate that you can access. My computer is delaying. I'm going to let Catherine show that. Yep. Thank you so much. So here's the certificate. Remember, you had to stay on the webinar through the full period. Answer at least 3 of the 4 poll questions. I hope you answered all of them. And get 12 out of 15 of the quiz questions correct. I think Catherine pointed out how you access the quiz at the end, so stay online for that, and hopefully you'll get that certificate at the end.
Okay, great. So what we're going to do right now is we're going to push out the survey to everyone. So if you would, while we're doing the Q&A, you should have a survey that pops up on your screen. And while we're doing the Q&A, we will have everyone fill out that. It should take only a few minutes to fill out the the survey. And then we're going to go to our Q&A. So, do we have all of our speakers ready to participate?
Yep.
We're ready.
Okay, great. Let's do that. All right. So we had a lot of questions. And so, Vanessa, since you were actually the first speaker, we're going to give you one of the first questions. Okay?
Okay, ready for it.
And certainly some of the questions, I just want to remind the audience, too, before I give Vanessa her first question, I want to remind the audience, please look at your console and the magenta-colored icons at the bottom of your screen. The one, there's two of them. The one that's next to the one furthest right will show you your progress, so you'll know whether you've answered 3 of the 4 poll questions. You will also know if you've listened to this webcast for at least 45 minutes. And the only thing you have to do after that, of course, is to take the quiz and get 12 out of 15 correct. Okay? So now back to Vanessa. So we have quite a few questions, Vanessa. And here's one. Question number 12. So during your presentation, Vanessa, this credit union is a small credit union. They said there are 24 million, and they're looking at participating in a business loan organized by a very large credit union. So what they're trying to find out, and you can help them out with this, and we can ask some of our other speakers to answer too. Can they use the underwriting? Can they use the organizing or participating credit unions underwriting to qualify the loan?
Thank you for the question. It's a very good one. So my quick answer is going to be you should use essentially a loan that's going to be in your portfolio should be your underwriting standards. Now, if you look at their underwriting standards and it's like, okay, that's okay, then that essentially is now your underwriting standards. But it's not, you can't just defer that and say whatever their standards are okay. You have to see if that fits with your credit union. I'm going to turn it over to my guest speakers, though, and have them answer the question, either of you.
Catherine, was it an MBL? I mean, I missed that piece of it.
Yes, they said it's a business loan.
Mm-hmm. Yeah, so Part 723 requires that someone on staff have a requisite 2 years of experience in MBLs or commercial loans, and if that's not the case, then they need to seek that experience independently. They can use the underwriting findings and the underwriting report of the originating credit union, and if they have the requisite 2 years experience, then they also need to complete a review of those underwriting findings, and certainly the report should indicate that they ran their own tests on the numbers and ratios. But if they don't have that 2 years experience, they have to go outside and get that. So I hope that's answered the question.
Vanessa, if I may add, I mean, at the end of the day, the regulations, whether it's consumer or commercial, do require the purchasing credit union to do their own underwriting. Now, that said, that does not mean that they can't rely upon and review the analysis performed by the selling credit union and the information provided by the selling credit union. But they certainly, at the end of the day, no matter what, it needs to meet their own underwriting standards.
Thank you.
All right, very good. Okay, so let me get Mike. Are you there?
I'm here.
All right. So your case studies were very interesting for our audience. So question number 95 for you. So the credit union wants to know, in the seller case study, why did ROAA drop so substantially after selling loans? They're interested in that.
Yeah, and I knew that would be a question, and they're probably question 95, 55, 35, and many others had that question. That had nothing to do with the loan participations. There were some commercial loans on the books that had losses that the NCUA came in and said, we've waited long enough, let's go ahead and take those losses. There were some updated appraisals that needed done on them, but didn't have any bearing whatsoever on in this particular credit union, the indirect auto loan participations that were sold.
Okay, great. So, Ian, are you ready for your question?
Sure.
All right. Question 96, here's the question. How involved, the credit union wants to know about the bookkeeping in participation loans. How involved in it is it, and do you know how it's shown on the balance sheet?
Sure. So loan purchases should absolutely be, they are absolutely loans on your balance sheet, and there is a section of the call report that's specific to loan participation. So you should not be viewing these as investments, but actually as loans. And then the monthly bookkeeping, honestly, shouldn't be any more difficult than your current tracking of loan information. Now, that obviously can be dependent upon the quality of the reporting you are getting from the selling institution. And so, I think as Mike mentioned and I mentioned, you really need to understand what type of reporting and how frequently you're going to receive that reporting and the payments. But it should be consistent with your other loans and should be treated as a loan on the balance sheet.
All right, fantastic. Okay, let's see if I can jump back to Vanessa. Okay, here we go. Question number, Vanessa, I think I know what your answer is going to be to this question, but the credit union wants to know, this is question number 43. They're looking to see if they can find any sample policies or agreements for participation loans.
So great question. The first place I always send credit unions these days or recommend they look at is a program called Policy Pro that many of the state credit union leagues have access to. So Policy Pro is a great program. What it is almost sort of a template for all sorts of policies. So that's a great place to look. So the other thing is, I'm not sure if you're looking to buy or sell, but again, if you're looking to buy participations, the sellers that you'll start talking to, they probably already have one that, and again, it may be kind of standard, and so you would need to read through that and see if, okay, if I want to partner with you, here's what changes we would need to make to that.
Okay. Also, Vanessa, question number 39, the credit union wants to know, you referenced the exam questionnaire on participation loans. Do you know how they can get to that particular questionnaire?
Sure. If you go to the NCUA website, www.ncua.gov, and search for exam questionnaires, and put it in quotes because the query just sort of looks at each word individually. And so if you put exam questionnaire, actually even make it singular in quotes, you should come to the site within the page within the NCUA website where you can have you can download the full workbook, which has, I think, anywhere between 15 and 20 questionnaires. And there's a first page that has a link to each one, and so you can find it there.
Okay. So let me jump to Ian. Ian, here's a good question for you. First of all, I want to let you know that you have a fan out here in the audience, but
okay.
Anyhow, so they have a question for you. They want to know what department of a credit union does your organization typically work directly with when it comes to participation loans, finance or loan processing, or who?
Yeah, it can differ between credit unions, generally speaking. It also depends on if you're buying or selling. The purchasing credit union, it's usually a combination of the kind of the CFO or finance department, and potentially also, bringing in the lending side, the chief credit officer or chief lending officer. But I would say as a purchaser, and even as a seller, oftentimes the principal group is kind of the finance side, the CFO side of the house, with support from other groups.
Okay. All right. So let me see. I had another question for you, Ian, before I switch over to Mike. Question 103, Ian. I think you mentioned something about an automated loan workout. So what is that?
Sure. So as part of the master agreement between you and any selling institution, will require you to have an agreement about how the underlying loan documents may be worked out, whether you can have amendments or waivers or consents. And so there should be rules about how that can be approved, that there may be certain things that the lead lender has discretion to do on their own. There might be other things that they need to get the approval of the purchasing credit union. So, for example, if they're going to extend the maturity date of a loan as part of a workout, that's something they would oftentimes be required to get approval from the purchasing credit union, and that approval takes the form of a vote. And so, what some of the technology vendors like we offer is the ability to send out automated notices and to track approvals among all the purchasing credit unions in real time so that everyone knows the current status of an outstanding vote versus doing it manually. So it really keys into kind of the terms of the purchase you're engaging in, and also speaks to the fact that people do need to monitor these loans in the event a workout is required.
Okay. All right. So, Mike, are you ready for a question?
Absolutely.
All right. So this is going to be question 77, and the credit union says, why do you say that participations are hard to stop doing?
Well, they're hard to stop doing because they run off just like any other loan that you put on your books at the credit union. So whether it's 25% or 50% or whatever the case may be, in a year you've got to supplement that growth, or you're just going to run off your portfolio. So now, if you've got enough organic growth to supplement the runoff of your loan participations, then that's fine. But once you start doing loan participations, even though your organic programs are functioning well and delivering results, imagine buying a $5 million or a $10 million loan participation and then never buying another. That runoff is going to take its toll on portfolio growth over time. So, and the only but is that if your organic growth is at a position that can supplement the runoff of an offset, I should say, the runoff of the loan participation.
Okay, very good. All righty. Let me get to, I'm going to give Vanessa a question. I had to reset my screen here. We're having some technical difficulties. So the question for Vanessa, there's no question.
Okay, I'll take it here. So somebody pointed out that they just wanted to clarify that per the final participation rule, and it's a good reminder, that a credit union is permitted to purchase a participation loan even if it doesn't originate that kind of loan. So I think this person may have thought that people might have misinterpreted my discussion about loans that you are empowered to make. Empowered doesn't necessarily mean that you've already made them, but empowered, remember, means that you have to have the policies in place. You have to have essentially somebody who knows enough about that product that when you're purchasing those loans, they know how to review those loans and essentially assess them as if they were your own, because now essentially they are. It's just that somebody else originated them. But it's a good point to make that, let's say if you're purchasing auto loans and you don't have any auto loans already on your books, that's okay. So thanks for that reminder.
Okay, well, Vanessa, here is another question that you and our speakers can answer. And this is a very good question. Question 48. So a credit union wants to know what's the difference between non-recourse and recourse.
Okay, I'm going to give that to my guest speakers because I know Ian is our attorney, so they're great at that. Go ahead, Ian.
Sure, former attorney. So almost everything we're talking about here today is non-recourse. And so what recourse means is not recourse to the borrower or the collateral, but rather to the selling institution. So if you have recourse to the selling institution in the event the loan goes bad, at the end of the day, what you've done is engage in secured lending. You really haven't purchased a true sale or a loan participation, and its treatment will be very, very different in terms of, for the selling credit union institution, its ability to reduce loan loss reserve. For the buying institution, you have to realize you really didn't buy a loan, you've actually made a loan to a credit union. And so you should be careful to make sure that when you're doing loan participation, that you're always doing it in a non-recourse way so that the purchasers actually put a loan asset on their balance sheet. The selling credit union is actually sold off that risk and can take and release loan loss reserves. because if you're doing it in a way that's recourse, it's really just a form of what really at the end of the day you've done is secured lending. So everything we're talking about today is non-recourse loan participation purchases.
So, Ian, I'm going to try to put it in fewer words if possible, because I remember learning about this concept years ago, and it's like, if you purchase a loan with recourse and the loan goes bad, who's responsible?
It would be the selling institution.
Okay. So it's whoever has recourse is the person that's essentially taking that loss, right?
Well, you as the buyer have recourse to the seller to get reimbursed for any losses. Now, there could be limits on that, but generally speaking, they would. That's what they mean by recourse. You would have recourse to the seller to kind of guarantee the outcome. Got it.
Okay, that's very helpful. Thank you.
Mm-hmm. Okay. So now we have a question for Mike, and Ian, you may want to chime in too if you like. And this is a very good question. Question number 55. So the credit union wants to know if the participation agreement and the master participation agreement, can they be one and the same?
Yeah, for the purposes of our discussion today, I don't know whether we referred to it, I think, as master loan participation agreement. I'm a little unclear. As I read this question, they are one and the same.
So we may have left out a word here or there.
Yeah, I may need more information, but they are one and the same. Ian, if you want to chime in too.
Yeah, I think the purpose of the phrase is to denote that it covers multiple loans. And so that's what they mean by master, as opposed to a participation agreement that was maybe subject to a single loan. But generally, people use the language interchangeably.
Yep.
Right. Okay. All right. So, Mike, here's another question for you. Question number 69. This is a good one too. The credit union says, does the participant have to underwrite every loan sold in a pool of loans?
Again, I think you need to come, and I'm going to assume, this is a pool of consumer direct or indirect auto loans, and certainly they don't have to do that. I mean, credit unions turn to me and say, how many are you going to look at for us, and I will respond given the size of the pool. So if the pool's $3 million or $5 million, it's not unlikely that I will review 100%. When I answer them, I like to see every credit union review anywhere from 20 to 25% at a minimum. But if you're buying a $50 million pool, that can be a challenge, and then staffing comes into play as well, assuming that you've got qualified folks to review those. So case in point, I'll use it as an example, just completed a $35 million pool for a credit union. I reviewed about, between the credit union and myself, we reviewed about 32% of those loans. It's an awful lot of loans, and they reviewed about 15 to 17%, if memory serves me correct. So it depends on the size of the pool and what your comfort level is.
Now, and Mike, and I think, if I may clarify what you're suggesting, which is you're talking about reviewing the actual note and the application and the credit score in like the paper format. I don't think you mean like electronically running to make sure that the credit score and the LTV meet their underwriting standards, because I would imagine you'd say that had to be true for every loan that they were purchasing.
Yes, that's correct. But we did look at every credit bureau, verified that there were liens on titles, had insurance, and a comprehensive review. It wasn't a high level or a macro review. It was a micro review of every loan file.
Yeah, no. That's why I was supporting your assertion. I just meant to say to try to distinguish between maybe what you were saying when it refers to physically reviewing a loan file and ensuring the electronic information meets the underwriting standards of the purchasing credit union.
Correct.
Okay. So now we have a question for Vanessa. This is question number 35. Interesting question. The credit union says, would they be able to use the lead lender's policy just for expertise? In other words, if they wanted to get into student loans, could they utilize their template to obtain a better understanding of the underwriting?
Thank you for the question. Here's my concern about the question. It sounds like student loans is a very new concept to you, and so you don't have any experience. You don't have somebody on staff who's done that or knows anything about it. So you're at the very beginning stage of trying to understand that. So I would not solely depend on a vendor who's trying to make a partnership with you to essentially help them as your sole source of learning on that. So talk to other credit unions who've been involved in student lending, look at their underwriting policies. You look at Policy Pro, see what's in there. So again, this is your vendor. So they've got a sort of vetted interest in getting you to agree to them, and so that doesn't feel like a good single source of education to me. Anybody else want to chime in on that?
No, I couldn't support it that anymore. Absolutely.
Okay, thank you.
All righty. So now let's jump down to Ian. Ian, you spoke about some technology. In question 100, the credit union said that the technology you were discussing requires both the originator and buyer to use the same, does it require them, rather, to use the same platform, or can it stand alone for just the buyer?
Well, our technology requires a single platform for both parties, although I imagine there could be other technology solutions available that is only one-sided. But we are certainly a platform that requires both people to be on it.
Oh, okay. I thought you had something else to add. All right.
Can I jump in?
Sure, Vanessa.
I'm jumping in, and I'm so loving all these questions, so thank you so much. And I guess I just want to sort of throw out that disclaimer again. While these guys are great and we're so grateful that they're here with us, remember that they are just two examples of vendors, and so the power of Google is amazing. Go to Google and look for, if you're looking for IT solutions, if you're looking for, CRESO's consultants, Google loan participation vendors, loan participation IT solutions, and you will find other players out there. So just wanted to put that out there.
Okay, great. So while I have Ian on the line, here's a question. The credit union was interested let me get my words together here. The credit union was interested as to whether there are any credit unions that are currently brokering or servicing peer-to-peer loans, and that's question number 94.
So,
they don't want you to name them. They just want to know if people are doing
sure.
it.
So, I guess, when I think of peer-to-peer lending, or sometimes people call it marketplace lending, with like the leaders being Lending Club and Prosper, those loans are originated directly by those financial technology companies and then generally sold to hedge funds and other asset managers. I'm not aware of a credit union directly purchasing loans off those platforms. I think it would be very, very difficult for them to do so. That doesn't mean that there aren't means for a credit union to use similar marketplace principles to kind of originate loans and almost like indirect lending defined. But I would say that the largest marketplace lenders do not sell their loans to credit unions.
Okay, fantastic. So let's pop to Vanessa. Vanessa, this is question number 40. Very interesting. We got this a couple of times. The credit union says, regarding the lead credit union retaining generally 10%, this seems like it was listed for a federal credit union. So the question is this also true for a state-chartered, federally insured credit union, or is this contracted to the applicable state regulator? Or in other words, is this to the discretion of the state regulator if it's a state-chartered credit union?
I understand the question, and thank you so much for the question, actually. The 701.22 actually talks about the regulation speaks to federally insured credit unions, whether you're state or federally chartered. So thank you for that clarification.
Okay, fantastic.
Vanessa, if I may, the regulation, don't mean to contradict you, but I think the regulation does allow for certain states to sell up to 95, but it's dependent on the state.
That's true. Very good point. Thank you, Ian. Yes.
Okay. Now, let's see what we have here. Mike, I think it's your turn again to get a question. Are you ready?
I'm ready.
So the credit union wants to know if the credit union can participate in a loan if the borrower does not meet the membership requirements. This is question 49, I'm sorry. May a credit union participate in a loan if the borrower does not meet the membership requirements identified in the credit union's charter?
Yes. I mean, the answer to that is yes. I don't know specifically what they're referring to. I can't imagine anything.
Can you speak up a bit, Mike? We can't hear you too well.
The answer to that is yes, they can participate in a loan even though it may be out of their geographic area or seg-based, whatever the case may be. I can't think of an example. Ian, maybe you can. I can't think of an example where they would not be able to participate.
Well, in fact, I would say that's pretty much the purpose of the provision, right, is to allow you to purchase loans from another credit union. Obviously, it's got to meet the membership requirements of the originating credit union. But the whole purpose of this provision is to allow you to buy loans from other credit unions, and that they very well may be, or most likely the case, have a different field of membership.
So we've had this question a couple of times, too, and I want to just give it to our speakers. The question has been participations, buyer or seller. Are those open only to credit unions, or can credit unions buy or sell with banks?
Well, Ian, I know, we both talked about this, and a credit union can buy from a bank, but they're not called loan participations. They're called eligible obligations. And those become very, very difficult to complete, those transactions. And the reason is that the buyer, the credit union, if you will, has to memorize each one of those. So I can't imagine under any conditions where, a bank would be interested in selling their loans basically one-off and having each credit union in a geographic area have to memorize that customer of the bank before that transaction. So, Ian, anything you want to add to that?
Yeah, I completely agree that while it's regulatorily possible to buy loans from from a bank, I would say that for a practical purposes, it's is unlikely to occur, and I wouldn't spend much time worrying about it. That said, it is completely fair game to sell to banks and to non-bank lenders like asset managers. That is very, very easy to do. So selling, it's not a problem at all. It just becomes difficult to do if you're purchasing.
Okay. So I'm going to have the final word on this. I'm going to explain one more time about the certificate process. If you listen to 45 minutes of this presentation, answered 3 of the 4 poll questions on your screen, not emailing them to us, but on the screen, and you answered correctly 12 out of 15 of the quiz questions, you will be able to print your certificate by accessing one of the magenta-colored icons at the bottom of your screen. Otherwise, you will be able to log back into the system in approximately 3 weeks, and at that time you can retake the test or answer the poll questions and get your certificate. We thank our speakers today. We are fresh out of time. We thank our audience, and we thank our Franz Ayento, who is our helper here from the IT department, for keeping us on pace. Thank On24, who is our platform provider. Please join us next month when we have a wonderful webinar. Vanessa will also be hosting this one.
Data mining.
That's it. Golden nuggets. So join us then. It's on what date, Vanessa?
I believe, that's a good question.
October 21st.
October 21st. Join us.
Please join us. Have a wonderful day and a great week. Goodbye.